John Colescott, there was a lot of talk about BDCs last year. Before we talk about what everyone else was talking about, what exactly is a BDC and why are they so important to the market?
Yeah, so BDCs are publicly traded private capital vehicles. They really invest in small to mid-cap U.S. businesses. We think of them as a hybrid structure of the closed-end fund and a stock. They have an earnings season. Historically, they yield above average. Right now, the large cap BDCs are yielding between 9 and 13%. But thinking a few years ago, when rates were lower, they're only yielding 8.5%, and the dividends grew like 30%, which is very powerful for investors. And we think that's really important to think of them as more of an equity vehicle, not a pure bond replacement. They're just focused on deriving their value from private credit. They're not a bond replacement.
And BDC stands for Business Development Company, which is a part of private credit. There was a lot of discussions about private credit last year, and BDCs sold off. Why was that?
Yeah, so our feeling was it's more on the expectation of rates coming down, so dividends coming down. The high-profile bankruptcies really weren't even private credit underwritten loans. They were in the BSL loan market, and they, of course, put a flashlight on what's going on there. We don't see many cockroaches. We just feel like good managers are going to be doing good work, and we focus in our practice on the dividend coverage and earnings are stronger versus weaker.
So if the cockroach headlines were overblown, what do the actual numbers say?
Yeah, so last earnings quarter, the average net asset value was off about 50 basis points, which is not a positive, but not terrible. The dividends came in about 2.7% for the BDC market. So annualized, it's like a 9% total return on the NAV or the net assets. We saw the return on equity or ROEs about 8.5%. The long-term average is 9%. So these are not terrible numbers. And while the non-accruals or other credit marks are more under the long-term average than above.
Is there an urgency to the next earnings season for BDCs to make sure that the all clear is all clear?
I mean, the really important thing to us is that BDCs aren't one thing. We really bucket managers in good, bad. You know, there's more quartiles than one answer. And so we feel the next earnings quarter will really show which managers underwrote good quality credit. They can trade these loans, but generally don't. And so we're expecting a positive earnings season while they deal with lowering their leverage costs, which can bring dividends down, also makes it easier for the companies to pay their debt obligation.
And then finally, I'll give you a chance to talk your book. Which BDCs do you like heading into 2026?
Yeah, so two different BDCs. One is Blackstone's BXSL. It's a $6 billion BDC, about a 2 discount to net asset value, 11 and mid-change yield. What we liked about it is a very low expense ratio over gross assets, X leverage, about 2 and low change. It really allows investors about 110% dividend coverage and really quality experience, low non-accruals. The other one is Bain Capital, BCSF, smaller, $600 million fund, and it's basically yielding a little bit more, 12.2. It discounts 20% because it's a little bit weaker of financials, only 1% non-accruals versus 0 for BXSL. And again, very good dividend coverage, very low cost of leverage, and very good, we think, financial trends for next quarter.
All right, well, thanks for coming on and talking about it.
Great to be here.